Jenny Brown and welcome to MFB News. I hope you're all doing really, really well. Parents, hang on in there. We're into the last week almost of the summer holidays and then normality will be resumed. Lots of great stuff to go through this week with you. We've got some really good lender changes to run through, some criteria enhancements and some repricing. The trend continues downwards. And then what I'm going to do is just go through the most recently published rental income analysis report and also the tenant demand report as well. Obviously as landlords, understanding where tenants' heads are in terms of demand for property is quite important to us. So definitely one worth sharing with you today. Okay, so kicking things off this week with Capital Home Loans, who have made some enhancements to their buy-to-let lending criteria. Now, the first thing that they've done is introduce the ability to accept intercompany loan deposits from connected parties. So this is all about limited company lending, where you have a limited company, which is maybe, for example, your day business, so you're an IT contractor as an example, or a dentist, and you've built up funds in that limited company and you're looking to use the money in that company as deposit on a buy-to-let, but you don't want to buy the buy-to-let through that company. You want to set up a clean SPV and run the two kind of business lines, as it were, very separately. Now, the way that you would move the money from the existing trading company into the new co, there's a couple of ways that you can do this. The way that no one wants to do it is have to withdraw the money from the trading company into their personal names, pay tax on it, and then re-lend it into new co. So there's various ways to kind of skin the cat on doing this, and different lenders have different requirements. But what Capital Home Loans has said is that actually we're very happy to accept the fact that Trading Co can lend the money as an intercompany loan to the SPV, which is really, really good news. Not all lenders will accept this actually, so it's really, really positive that Capital Home Loans are doing so. Incidentally, I should say there are other lenders that do accept this structure, but not all of them. Now, what they've also done is changed their rental calculation for high rate taxpayers. This is if you're borrowing personally. If you're a high rate taxpayer, the industry standard, and there are some variations on this, but generally speaking, the calculation would be that the rent would need to be 145% coverage, assuming a notional interest rate of, and it tends to be either 5.5% or roughly the pay rate if you're taking a 5-year fixed rate. Now, what Capital Home Loans have done is said is, okay, well, if you're a higher rate or additional rate taxpayer, we're now reducing it from 145% coverage down to 140, so another really positive development there. Now, what they've also done is increase their exposure development on the number of flats that they will lend to in any given development. So what they're saying is that if there's up to 6 units in the flat, they're happy to lend on all 6 of those, whether they've lent to them all 6 via you or whether there's various different parties involved, but fundamentally they could take on all 6 in a block of 6. If there are between 7 and 20 units, they're going to do a very maximum of 10 units within the block. So if there's 7, they'll do all 10. But if there's 20, they're going to cap out at 10. And if there's more than 20 units, it's the highest of 10 units or 20% within a block. And again, this is really relevant and comes up often, particularly, I would say, for those developers or landlord clients who do a bit of developing, who have converted a building into multiple units. And what they don't want to do is put a mortgage on the freehold, so leave all the flats on the title, because what you will find then is when valuers go out and value it, they tend to take the sum of the parts and then discount the value by roughly 15 to 20%, which then impacts on the valuation and therefore how much you can borrow. So what a lot of our clients want to do is actually put long leases on every single unit and be able to then borrow on them individually, because this can improve the amount of money that they can raise. So this exposure limit comes up quite often actually, so it's really great that Capital Home Loans have made some improvements there as well. So look, in terms of Capital Home Loans, more roundly as a lender, who are they, who they're looking to lend to? So they're a lender who can lend to individuals and limited companies. There's no maximum number of properties in the background. They do require an income of £20,000 per year, and that can be across multiple applicants. So if there's 2 of you, between you need to be earning £20,000 a year. And this can be comprised of rental profit, by the way. They accept day one remortgages against open market value. You can be the maximum age of 85 on maturity of the mortgage. They can accept studios with a minimum size of 35 square metres and a value of £100,000. They're okay with properties over commercial, new builds and ex-local authority. So actually they've got a really, really solid offering there, and it's great to see they've made some further improvements to it. Santander have made some rate reductions of up to 60 basis points across their range. Their pricing on buy-to-lets now starts from 1.25%, and that would be on 2-year money. Now, in terms of Santander and who they are as a lender, for me, that I don't feel they've got their buy-to-let offering in a position where it would appeal to the majority of our clients. Having said that, there's still a real raft of people who this would be very appealing to, particularly because their pricing is incredible. And actually, from experience, I would say their service levels are also very, very good. Now, if you're looking at a 2-year fixed rate with Santander, the rental calculation is going to be either 145% or 130% coverage, and that depends whether you're a lower rate or higher rate taxpayer at 5.5%, which really means that particularly in the southeast of the country, your leverage based on the rental yields is probably not going to get up to 75% loan to value. But outside of the southeast, for those properties which tend to yield a bit better, there's a strong chance you may be able to get up to 75% loan to value nonetheless. They're only lending to individuals, no limited companies. You can have no more than 7 buy-to-let properties in the background with Santander. One of the things that I genuinely believe is that they are very, very good at unusual property types. They're very good at things like dex access, ex-local authority, eco homes. So they've got a really good sort of appetite to lend on those less standard properties. But like I say, in terms of their offering, it is relatively conservative in terms of the rental calculation, in terms of appetite for background portfolio, and also your own income as well. It needs to be £25,000 a year, so very, very standard, particularly in that regard. Now, in the last week, Landbay have made some improvements to their offering as well in terms of pricing. So their rates now start from 2.85%. Now, Landbay as a lender operate, I would say, more in the specialist end of the market. So 2.85% in that arena is very, very competitive. So they've brought out some really nice 5-year fixed rate products. They've also brought out some green mortgage products. They have one product which is available with EPC ratings of A and B, and a second slightly more expensive product which is available for those properties with EPC rating of C. Now, in terms of Landbay as a lender, like I say, they really are a specialist lender. They're able to lend to individuals and limited companies, no maximum number of properties in the background. With limited companies, they are looking to underwrite the shareholders and directors. They can accept layered companies, so a company owned by a company owned by a person, which reverts sort of nicely back to when we were talking earlier about capital home loans and their source of deposit for intercompany loans. Another way that people would move money from trading co to SPV is that they would set up the SPV as a subsidiary of the trading company, and then you can move the money down from one company to another without incurring any taxation. So look, what else do they do that's really good? So they do have a minimum property value of £65,000 in some postcode areas. In the others, it's £75,000. They can accept day one remortgages as well against open market value. They do need you to have an income of £25,000 per year. But in the round, they have a really solid offering, and actually the pricing, particularly in the specialist end of the market, is very good. Okay, a few more lender updates for you briefly. So first of all, Platform Home Loans have reduced some of their buy-to-let rates. Platform Home Loans are a high street lender, so no limited companies. Fairly conservative lending policy. It's pretty standard, to be honest, maximum of 10 properties in the background, £25,000 a year income, all that kind of stuff. But their rates have come down, which is fantastic. We've also seen Barclays add some products to their offering in terms of buy-to-let. The one which I'm most interested to share with you is a 10-year fixed rate. The rate is available to 75% loan to value. It's at 2.75%. and has an arrangement fee of £1,795. Now, 10-year fixed rates are a funny one. We get asked about them often, and then when we tell our clients the pricing, they tend to say, actually, I'm fine with the 5-year fix, because that tends to shave a large percentage off of the interest rate. If you imagine yourself as a lender, when you're lending money on a fixed rate basis for 10 years, you're trying to kind of second guess what's going to happen with interest rates over that period of time. So it comes with a real sort of element of risk for them. And arguably it could come with an element of risk for you depending on how the market plays out. If you took a 10-year fixed rate at 2.75, then interest rates don't move for the next 10 years. Arguably you've lost out, right? But actually the reality is that they're probably not going to stay where they are. Well, they certainly won't stay where they are for the next 10 years. I might be surprised if they stay where they are for the next 1 year. So there is an opportunity to potentially do very, very well. But I think for our landlord clients who are interested in 10-year fixed rates, for them, it's not about trying to second guess the market and end up with the best deal. For them, it's about security and being sure about what's happening. So they know that for the next 10 years, they have a set amount of money to find each month to cover the mortgage interest costs. There would be an expectation that over a 10-year period, their rental income is going to increase. So their profit would increase, over time. And also there's the reality that you don't have to remortgage your rate for 10 years, which some people, that's really appealing. We have some clients who really enjoy remortgaging, really kind of researching the market, trying to get the absolute best deal that they can, shaving off a few basis points here and there. And for them, that's really, really important. I mean, I go so far as to say for some of them, it's actually like sport. But we also have other clients who really want a bit of a quieter life. They don't really want to have to get involved in doing these things so often. So for them, just taking a 10-year fixed rate they can simply forget about is really, really appealing. Now, Barclays' 10-year fixed rate is not the only 10-year fixed rate on the market, but actually is one of the most competitive 10-year fixed rates on the market. Now, in terms of Barclays as a lender, I'm just going to be quite candid about this. They are not looking for what I would class as kind of professional landlords. What they're looking for is, the person who has a day job with a strong income, who has one or maybe two buy-to-lets in the background. And I say that because of the way that they assess the rental affordability or the affordability calculation. What they're not doing is a standalone rental calculation like most lenders do. What they're doing is looking at the affordability of the client in the round across all of their income and all of their expenditure. And what this tends to mean is unless you have an incredibly well-paid job, this tends to mean that actually really, the numbers only tend to work out if you have a very, very small portfolio. But look, that's the large chunk of landlords, and it's a very, very good rate. So one definitely which I thought was worth sharing with you today. Okay, a quick touch on the property market and what's going on there. So I read a report in the week which told me that the supply of property is beginning to increase. This is supply of new homes to buy. And the number of homes selling for over the asking price is starting to even out. And this is according to data from the NAEA property mark. So the supply of property, in its figures, it showed the number of properties available per member branch stood at 28 in July, which was a jump up from 23 in June. They went on to say that, however, year on year, this is the lowest figure ever on record for the month of July, with the previous lowest July being during 2017, with there 35 houses available to buy per branch. The average number of house hunters registered per estate agent branch stood at 428 in July, which is a marginal increase from 426 in June. Year on year, this is the same as during July 2020, when the figures also stood at 428. So this means there is an average of 15 buyers for every available property in the market. So I think in terms of what this is really telling us, definitely there has been a shortage of stock on the market, and with loads of people looking to try and acquire property, partly because of the stamp duty holiday, partly because people are looking to make changes to their kind of living arrangements, and partly because people have just done nothing for the last couple of years and demand has really just built up. The shortage of supply really kind of led to the prices really starting to go up very, very quickly, which we've seen over the last few months. But now what we're seeing is actually there's more properties sitting around. However, the demand for those properties, the number of people wanting to buy one essentially has stayed steady. So this is really to help kind of slow things down and just take a bit of the heat out of the market, which I think really can only be a very, very good thing. But still, I stand by my predictions. I'm not expecting house prices to come down. Landlord survey time. I love a landlord survey. So the Mortgage Works, who are incredibly generous with their budgets, commission various reports throughout the year quarterly, where they go out and reach out to landlords to really find out how they're feeling about things, what they're seeing in the market, how they see the market changing over the future and how it's impacting their business. So really, really useful, gold information that comes out from these reports. Now, they've produced two in the last week. The first one is the Tenant Demand Report, which is covering Q2 in 2021. Now, this one really is to understand whether landlords are seeing rental demand increasing, decreasing or staying the same. And I think really the key takeaways from this report is that 38% of landlords are seeing tenant demand increasing. There were 12% of landlords who had reported it decreasing, and there was 26% of landlords who were unsure. Now, when we look back at this time last year, the way that they kind of produce this report, they kind of apportion a score to the numbers. So now we're sitting at plus 26. This time last year we were at minus 11. And when I look back over the last 7-8 years, actually I think on average we probably would have sat at around kind of plus 22, plus 23 around that mark. So the fact we're sitting at plus 26 really just shows that landlords are feeling incredibly confident. I'll just kind of try and show you this report. You can see the green bars. So this is 2017 and this is now, and you can see the way the numbers kind of move around. But really what it's just going on to show is that, yeah, like I say, tenant demand is really increasing. If you would like a copy of this, please do get in touch or leave a note on this video and we'll be very happy to share one with you. Now, the Mortgage Works have also released their rental income analysis report, which is the other one which I really enjoy reading. This is really talking about what's going on with landlords in terms of rental income. So the report is pretty chunky. It's around 10 pages of data. I'm not going to go through the whole thing. Like I say, if you'd like a copy of these, we're very happy to share them with you, so just get in touch. The key takeaways here, so the average gross rent for a landlord is averaging at £54,000 per year, and this is unchanged from the previous quarter. However, what the report did note is due to the size of typical landlord's portfolio falling over this time period, so from 7.8 properties in quarter 4 2020 to 6.9 in quarter 2 2021. So the annual rental income generated per property has actually increased by over 10% to £7,849. It's just that because there's less number of properties in the mix, the average gross rental income across the whole portfolio has stayed the same. Now, 26% of landlords were reported to have increased rents in the last 12 months, and perhaps most reassuringly, 29% of landlords are planning to increase rents in the coming 6 months. So look, in terms of rental trends and intentions from the landlords who were involved in the research, so look, 50% of landlords said that rents are rising, only 9% said rents are falling, 26% reported no change, and 14% were unsure. In terms of the landlords survey, in terms of the next 6 months, 29% are planning to increase rents, 5% think they're going to come down, 58% are not expecting any real change, and 8% just weren't sure. So I think really, as a landlord, this is the kind of information that you really want to be hearing in terms of people feeling fairly positive with regards to rental income going forwards. And there we go, a smorgasbord of information for you this week, which I really hope you have found helpful. Have a great bank holiday weekend. I think I heard on the radio last night that it's going to be not bad weather. At least it's not going to be raining, so that's great news. If you do have any questions on anything we've talked about today, or indeed anything, mortgage related, we'd love to hear from you at 0345 345 6788. Until next time, do look after yourselves. And I'll be back again next week.